Iran utilized what is normally a quiet holiday lull to make the most of its military maneuvers in the Strait of Hormuz, which concluded after 10 days. The Navy's latest round of test firing of long-range missiles raised the stakes on the vital artery for a fifth of the world's crude exports. But it is Iran's currency that took most of the heat. In a quiet period for global markets, energy prices have not responded to Iran's military exercises. The benchmark crude, North Sea Brent, has hovered near $107 a barrel since Iran started its military exercises. The U.S. sanctions legislation signed by President Barack Obama continues to keep Iran's currency, the rial, near record lows, which could spark inflation by making import costs much higher. Local wire reports say the rial fell another 6% in local trading. The sanctions legislation singles out the country's central bank, which strategists say could limit Iran's ability to import and export. The action to cut off the arteries of the financial system makes it very difficult for a country to trade any of its assets, most importantly oil in Iran's case. Iran earned $73 billion from oil exports in 2011. The oil sanctions being considered by the European Union would cut off less than a quarter of that total, or about 450 to 500,000 barrels a day. Facts Global Energy is estimating that sanctions could reduce Iran's exports by 10 to 15%, with an annual cost of about $15 billion. Energy strategists say there is already a premium built into today's price, but that premium is for a threat, not military confrontation in and around the Strait of Hormuz. John Defterius, CNN, Abu Dhabi.